Hi, everyone. I'm Milan Handelsman, National Sales Manager from Raintree Financial Solutions, and I'm delighted to be joined today by Cooper Seaman, who's the principal at Regimen. It's going to be an excellent presentation today. I've been through the slide deck, and I'm excited for you all to go through it. Please, at the bottom of your screen, there is a Q&A box. That is where I'd like you to please type in any questions, comments, thoughts that you have. I'll be monitoring the Q&A box throughout the presentation. But for now, I'm going to hand the reins over to Cooper. Welcome and thank you.
Oh, thanks, Alon. Appreciate it. And thanks everybody for joining today. I'm looking forward to telling you about what we're up to, and hopefully we'll have some new investor interest after the call. So let me just share my screen. Are you seeing that, Alon?
Yeah, sure am. That looks great.
Great. Okay, I'm hoping to talk for about maybe 30 minutes about what we're doing about the Regimen Partners Income Trust, and there should be lots of time for questions and answers towards the end. I prefer to talk about things that are of interest to the participants, so we'll just dive right in. We started Regimen in 2014. We're a long hold fund, and we're focused on investing in small to medium-sized enterprises across Canada. We have a value focus. Of the 6 companies that we do currently own, we've bought between 4 and 6 times earnings. We have a long hold approach, which I'll get into a little bit later, but it's a lot longer focus than traditional private equity. We have national deal sourcing, so we'll get into our specific portfolio companies, but we're currently from Montreal through to Vancouver. And we have an office in Toronto, and our head office is based in Vancouver. Over the last 6 years, we've raised over $86 million from a whole pretty broad array of investors, from high net worth, family office, and some leading financial institutions. When we started Regimen, our phase 1, as I like to call it, was to raise $60 million and deploy it into 5 or 6 companies. We completed that in 2019. And we're now on the early innings of phase 2, where we're looking to raise $90 million. We're 15 million of the way through that, and deployed in another 6 to 8 platform businesses, all in the same holding structure. All of our investors get exposure to the existing 6 companies that we have, plus the 6 to 8 that we hope to acquire over the next 5 years. Here's a bit of our team. You see that we have some pretty deep private equity expertise. My partners, David Eisler was the managing partner of a private equity firm in Vancouver for many years. They did 2 institutional funds, raised $145 million, invested in 15 companies over 15 years. And my partner, Jerry, he was a sell-side advisor and spent 25 years at one of the premier independent corporate finance advisory businesses. So he has a lot of experience working with sellers of businesses, and now he's sort of switched over and is now buying businesses on our account. We like to start off our presentation talking a little bit about our core values, which you can see here. We're very relationship focused. Canada is a very small business environment, and we think it's really important that you live up to your promises that you make as best you can. We're very goal focused. You'll notice, and I think Lon can probably explain a little bit about, we're pretty forthright in our comments, and we try to do things a little bit differently than a lot of other groups. Part of the philosophy is, if you do everything the same way everybody else does, you get average results, and if you do things a little bit differently, hopefully you can get above average results. So that's what we're focused on. A bit about our strategy and how we're different. We focus on the small to medium sized enterprises. That's what we call $3 to $10 million of EBITDA, which is earnings before interest, taxes, depreciation, which is how private company buyers look at the size of companies from an income perspective. As I've mentioned, we're a long hold fund. So most private equity funds they focus on a 10-year partnership life, buy businesses for 5, and then sell their investments over the next 5. We think a little bit more like business owners, where we are looking to buy businesses that we want to be majority owner for the next 15 plus years. We think that's a better alignment with all the stakeholders in the business, and that's really hard to find a great business. So why sell it after 3 to 5 years. As I mentioned, we have a national investment mandate, and we do have some liquidity events within the portfolio. So even though that we're looking to own businesses for a long period of time, that's typically longer than investors' investment horizon, we provide liquidity at the fund level for investors. So that's more traditional from that perspective. In terms of our purchase criteria, we're looking for diversified revenue streams. We're looking for businesses where the current owner has been constraining growth. Sometimes the next phase of growth for the business is beyond the capabilities of the current owner. So that's like a good time for us to step in. But then we always like to buy businesses with a business partner that can lead that next growth. So sometimes that's somebody in the business. Sometimes it's somebody new that we bring into the business. We're focused on businesses that are headquartered in Canada. We would consider going into the US Northwest as a headquartered business, just given our proximity to that. But we generally look to get US exposure through expansion of our existing portfolio companies as opposed to buy a business that's based in Miami, say. We try to stay away from businesses that have high capital expense needs, because then we find that there's not enough cash flow to return to our investors. And we're always focused on the price that we're paying with the businesses. Here's a slide that shows a little bit about how we see the market. We're more focused in 20 million plus sort of valuation, if you will. And so we're seeing on average that multiples of those businesses are 5.5, 6. That's what we've been buying at recently. When you go up to the next strata of the private market, you see a pretty dramatic increase in valuations. These numbers are a little stale dated. I would say that there's not a lot of data for 2020, but what we're starting to hear in 2021 is that both the smaller businesses as well as the larger businesses, it's kind of moving up a little bit more, but we're seeing it move up more in the larger business segment than it is in the area that we're focused in. Yeah, just a comment about our long hold approach. We believe that owning businesses that it's hard to find a great business and at a price that you like. And then once you make your investment, that's when the hard work begins. And so you really need to spend a lot of time working with management to try to grow the company and put that in the right strategic direction, bring in the right management. It takes a lot of work. And that can take 3 to 5 years. And hopefully when you're successful, after having done that for 3 to 5 years, you've got the company going in the right direction and growing. And it doesn't make a lot of sense to us where traditional private equity would then turn around and sell that business. We'd rather hold on to it. It's generally going to be less work for us after that. We understand a lot more about the business, so we think that there's less risk for us. And if we were to sell one of the businesses, then we would have to go and find another business to put that capital into, be a bunch of leverage on that, which makes it risky. And it's typically in a business that we don't understand as well as the business we just sold. So unless there's a good reason to sell the business, we've created a structure and a model whereby we can continue to own those businesses for a long period of time. And that helps build wealth rather than just drive for quick turnover with the businesses. We also think that it's a better alignment with all the stakeholders of the companies. So when everything's going right in private equity, all the stakeholders are pretty happy. The employees, the customers, the lenders, everybody's happy. But when things get rocky, and they often do, sometimes some of those stakeholders aren't treated the way an ordinary business owner would with private equity. So I think our model is a little bit closer to respecting all those stakeholders and really thinking about that, because some of the happiness of the employees, for example, maybe it doesn't matter so much in the short term, but long term, if you're really focused on that, I think you care a lot more about the employees. We think it also attracts better business owners. We've had lots of conversations with companies that we're looking at investing in, and when we tell them about our approach and strategy, they're like, oh, that makes sense. They probably wouldn't have considered a private equity investor in the past, but with our focus, they tend to warm up. So we sometimes get opportunities that other private equity firms with a more limited mandate might not get an opportunity on. And one of the things that, that we believe in is that over time, you actually make a lot more money by holding on to your businesses. Bain and Company, which is a US consulting firm, they did a study a couple of years ago, and they believe on an after-tax basis, the returns are double over long periods of time if you're just holding on to your businesses versus selling them, paying the tax, being underinvested and reinvesting. And so that's part of the methodology that we're focused on. Here's a little bit about our portfolio. Diversification is very important for us because I think that's what allows you to stay viable over the long period of time. I think if you have a shorter investment mandate, maybe diversification isn't quite as important, but when you're prepared to live through multiple business cycles, I think the diversification is important. So we're diverse by province on our sales side, and we hope to expand on that diversification as we add the next 6 to 8 companies that we're hoping to by the end of 2025. Here's a little bit about how we're diversified by industry. Some of our earlier businesses are a bit smaller just because when we started out, we weren't spending as much per company. And some of the larger ones are the more recent acquisitions because they were able to invest more money, and frankly, they've also grown the fastest out of our portfolio. So that's made our earlier ones not quite as large. But you can see just from the industries that we're in, they're not correlated. We actually spend a lot of time talking about what concentration we have in a given industry, and we don't want to be overly concentrated in industry or by province. A little bit about our investors here. You'll see that we have all sorts of investors. We appeal to a broad range. Traditionally, we've been high net worth fund, and then as we gained a little bit more of a track record, we started to bring some family offices into the mix, and more recently we're starting to bring in institutional investors into our funds. So it's a big vote of confidence. We have a couple of very sophisticated financial institutions in our fund now. A little bit about our existing portfolio. The combined revenues are over 200 million. Our EBITDA is approximately 25 million. We tend to we don't like leverage we like it a bit, but we don't like to push the envelope on leverage. So you can see right now we're probably a little bit lower on the leverage side of things than traditional funds. You tend to see maybe 50% or more would be leverage. You can usually get 60%, but we like to be a little bit lower. It allows us some freedom to pursue acquisitions, and it also allows us to ride through some of the things that happen like COVID-19 and not feel that our entire organization is at risk. I'll quickly go through some of our companies sort of in reverse order. KNC Silviculture is a forest seedling grower based in Oliver, BC. Great business, very steady, low risk. We're looking to benefit from Justin Trudeau's 2 billion tree initiative. That's something that got announced after we made our investment. They grow 38 million seedlings per annum. And one of the great things about this business is you don't spend money and time growing your inventory unless you have firm orders. So there's very little risk compared to some other businesses. And this business also came with a lot of land. And so that sort of underpins value for us. I think about 60% of our purchase price was backed by land. Radio Engineering, we bought in 2018. They provide pro audio accessories like this DI box that you see on the picture. This is sort of a staple of the music industry. The business also does acoustic treatment panels. So that's when you go into, say, a restaurant, it's very noisy. We can retrofit the restaurant to be able to hear other people at the table speaking. So it's sort of audio related, but it's not for the music industry. The DI boxes are really a gold standard in North America. They're used by Sting and the Rolling Stones. It's not so much the artists as it is really the sound engineers that they employ. And so it's kind of a staple. There's a lot of things in the music industry that can be very faddish, but this particular product, and the reason why we like Radial, is that you don't have to re-engineer every year, and you get sales year in, year out. All Gold Imports is a food distribution business. We import nuts and seeds from 32 countries around the world, dried fruit, frozen fruit, and we sell to the commercial bakeries and the snack manufacturers in Canada and the US. We've been working with the team to expand into the US, and I guess it's taken us a while to get down there, but for the last 6 months, we've been locating some product in the US and starting to sell, but that's where the growth of this business is. And they have a really high working capital in this business. They have a lot of inventory that underpins value in the business, which we like. And it's also allowed us through COVID to continue to meet customer commitments that we've made, and a lot of groups have had a lot of trouble meeting those commitments. So as we roll through the pandemic, I think we'll be coming out with a reputation even more strongly than was there before, that we deliver, and I think that holds us in good stead go forward. Plastifab is a plastic extrusion business based in Montreal. These aren't single-use plastics, they're long-term linear shapes that are produced. They specialize in custom order, smaller volume runs compared to some of the high volume extrusion businesses. It means that we have to be very nimble and be able to change our setups very quickly. But the flip side is that we appeal to a lot of different industries. And so we're able to pivot as needed. For example, we started producing a lot more product for the pharmaceutical industry during the pandemic, which hadn't been a large percentage of the company's revenue in the past. And the other advantage to the short runs is that they're high margins. So as long as you're efficient on the turnover, which Plastifab is, it's a really great business to be in. They sell all over North America. It's half to the US, half to Canada. So we've got a really great team there. Central Technology Services, it's not actually a technology company. It's more of a financial facilitator to the technology industry. And so Central gets involved with large companies like Royal Bank, Bank of Montreal, Manulife, Canadian Tire, and they facilitate a more efficient purchasing structure for large software companies like Oracle, some of the big vendors. There's too many of them to name. I think we were approved with 25 to 30 software vendors. And effectively what the company is able to do is to allow people to meet their budgetary constraints and still get the best pricing that they otherwise would not be able to get from the software vendors. And so we take a bit of those savings as we get involved with various technology purchases. And all of our customers are very large companies, so we don't have a lot of receivable risks. That's a great little business that keeps chugging along. And our first business that we invested in was CRS Crane Systems. We build and maintain overhead cranes that you'll find inside warehouses. And then we've had to pivot with that business where we were largely based in Alberta. At the time, things were going very strong. So in 2014, 2015, there was the oil price-led decline in Alberta beginning in 2016. And so we've expanded the business into Ontario, focused more in BC, and recently brought aboard an exceptional CEO to lead the charge to grow the business from here. Just another great little business that's the backbone of Canadian industry. And we typically will get questions around COVID-19 and how we've been faring. As of about a month or two ago, we hadn't really had any employees testing positive. We did have a number of people in the last month or so in Montreal get tested positive. There wasn't any outbreaks. Everybody's been safe and everyone's back to work, but there was a bit of stoppage there, or slowdown, if you will. But everywhere else has been managing to operate throughout the pandemic, which is great. There's a lot of businesses that were shut down for periods of time. Our senior lenders have been very supportive with us. We haven't, in fact, the conversations are generally, can we give you more money, as opposed to them being worried about how we're doing. I think that's partially our management style and partially our lower leverage that we have. And frankly, the financial impact of COVID to our companies on portfolio basis hasn't been nearly as bad as we had feared a year ago. So our 2020 results on a portfolio-wide basis are down only 5.5% from an earnings perspective relative to 2019, and 2019 was a great year. So we're pretty happy with that performance, given how impactful this has been across the Canadian business landscape. A little bit about the terms of the Regimen Partners Income Trust. We offer preferred securities. They pay a targeted distribution rate of 8.5% per annum. We have been using these to finance our portfolio since 2015. We make monthly payments and we've never missed a monthly payment to date. The securities are eligible to be held in registered accounts, and the interest is paid when the distributions are made. They're treated as interest for taxation purposes. And after 5 years, investors can ask to be redeemed at par. And we just went through, we had raised a lot of money in 2015 on this basis. And we just went through a process last year where we offered all of our investors the ability to renew for another 5 years at new lower rates, the 8.5. A lot of people said yes, they're interested in that. There were also a lot of people, for all sorts of reasons, that said they weren't interested in it. It usually had nothing to do with our performance. It was more about their current financial circumstance. And we were happy to return their money and bring new investors to bear into our fund to replace them. And we just think it's important that when at all possible, as an investor, when you ask for your money back after a set period of time and the agreed upon terms, that you have the option to get your money back. The preferred securities, they rank in front of all of our common investors, and I'll go into a little bit more about the numbers on that in a second. And they're behind any creditors of our business. So for the most part, it's the senior lenders at our operating companies. In terms of how much coverage there is for making the payments, this is how we look at it. When you factor the interest that we have to pay to our senior lenders, we have about $22 million, $23 million across the portfolio to pay. We don't own all the businesses 100% because we have managing partners that run each one of the businesses. So we have about 71% of that. So our share is around 16 million. And right now, go forward, we're just over 3 million in terms of preferred payments that we're scheduled to make. So that's about a 5 times coverage ratio, which we think is quite healthy. That also doesn't factor in the fact that we actually have a little bit more cash than we normally do in our balance sheet, and we're looking to deploy that into our next acquisition. And when that happens, the preferred distributions won't necessarily go up, but we'll have more EBITDA available to service. So I think that should improve over the course of 2021. Lastly, the other way that we look at this is how much risk are the preferred securities taking? And so at the bottom of this slide, you'll see that the first 27 million is really the share of the portfolio company debt that ranks ahead of our preferred securities. And the preferred securities are between 25 and 52% of the total capital that we have. And there's 53 million of common equity. And so the important point for the preferred investors is that entire $52 million would have to be somehow lost before our preferred investors take $1 of risk on not being repaid back their capital. And so I think that's really important because you need to look at the rate in conjunction with how likely you are to receive your capital back at the end of 5 years. We've got, there's a little dotted box up top. We introduced last year a more traditional common equity way for institutions to invest into our partnership. And we have $7 million worth of committed capital that we're able to draw to make acquisitions on a go-forward basis. So that's additional capital that we haven't drawn on yet that will help fuel our business go forward. And that's all common equity as well. Just in summary, look, I really like, obviously, the small to medium-sized enterprise space. We think it's, from a private company point of view, it offers the best value. You're holding businesses for a long period of time versus cycling through, we believe is the right way to be an investor in the space. On the preferreds, we think it's very attractive yield when you factor in how much security there is in terms of getting repaid, not legal security, but just financial numbers for how much common there is supporting the repayment. And we're continuing to grow the diversification over time. We spend a lot of time every day trying to expand on that. So it doesn't go as fast as we'd like, but I think we're going at a pretty good pace. And you've got a great team. I spend a lot of time building out the team, and I think we've got a top-notch team to steward our investors' money. So I don't know if you want to go to questions now, Lon, but that's kind of my presentation.
Great. Well, thank you very much for that, Cooper. We have quite a few questions here, so let us begin. So Gary says, I'd like to understand the mechanics of how a long-term hold, 15 years plus, offers liquidity in 2 to 6 years. So could you please break that down and explain?
Sure. So I guess the best way to look at this is it's more of a comment for our common investors. One of the things that we've offered them is the ability, like we basically are going to pursue a major liquidity event in the next 2 to 6 years. That might provide liquidity on the preferreds, or it might not. It might be a 5-year hold for those investors, but that's what that comment is about. So instead of selling our businesses to create liquidity, which is the standard private equity approach, we provide liquidity at the fund level so that the fund and all the other investors can continue to hold on to the companies and the investments they're in.
Great. Okay, thanks. Next question. With revenue and EBITDA down due to COVID, what are you seeing moving forward into 2021 and 2022?
Yeah, I mean, it's been interesting. We've had a couple of businesses that weren't really affected financially from COVID. We've had some that are doing better, not because of COVID, but they were just already doing better. And we've had a couple that have been more impacted, in particular Plastifab and radio. Obviously live music, it's down, but we've been profitable all the way through. So for those two businesses, we see a resumption of growth. The other businesses, I don't think that we're going to see anything different. So the growth internal that's sort of embedded will continue on. One of the things that we're seeing that's COVID related, but it's impacting all businesses, is that there's a lot of friction in global logistics. And that's impacting a lot of our businesses in all sorts of different ways. And so I'm hopeful that as COVID dissipates, that friction dissipates as well.
Okay. Maybe this is a good time, Cooper, to pivot to a conversation about the pipeline, because what's happening with the existing businesses in the next couple of years is one thing, but what about new acquisitions that you're looking at? What does the pipeline look like today?
Yeah, it's well, I'll talk a little bit about the market and then I'll get to the pipeline along. So, the market, as you can imagine, when COVID hit, really dropped off. So a lot of the opportunities, the investment opportunities in the market, I'd say about 80% of them were shelved at that point in time. We saw a resumption of the market return sort of in October of this year, and it's really gathered steam in the last couple of months. There are so many opportunities. I think it's partially pent up transaction demand that didn't get closed in 2020. And I think part of it's also that business owners have also been through a really trying time. Maybe they were already thinking about selling their business, but COVID has maybe increased their resolve to sell businesses and maybe given sellers a little more focus on getting a sale completed than trying to get the highest price than they possibly can. So I think we're on the early stages of that wave, which in previous disruptions I've seen could be a year or two. And for our pipeline, we've actually been working on an investment since April of last year, and we're hoping to have it closed next week. I don't want to say too much about it because it might not close, but it's a great business in the life safety spectrum, and it's been around for 126 years. So it's a great kind of business that we really like. We also have two other investments. We have an add-on for All Gold that we've been working on for quite some time, and we're hoping to close that in the next couple of months. And we've just recently put another transaction under exclusivity. And if that one closes, we'll close that in the next 3 to 6 months. But lots still left to do on that business, but another really great business, then great business partners on that one in particular, and a whole lot of other things that we're working on. Our list is growing. We got 2 pages worth of transactions that we just reviewed yesterday, and a lot of that we might not bid on, but that's our opportunity set right now. So it feels like it's kind of double normal.
Okay, that's very instructive. Thanks. Can we maybe pivot and just talk about how you structure the deals with the companies that you're purchasing?
Sure. I think the question you're asking is how do we structure the capital in a given operating business that we invest in? So typically what we do is we'll put about 50% of the purchase price. We'll fund that from senior debt. And then the other 50%, what we do at the company level is we do half of that as a shareholder loan or some other sort of fixed security where we'll be able to get payments. And so that comes into our holding company, which we then make the payments to our preferred investors. And then the other 50% is common equity in the company. And we're trying to replicate how we manage our fund, and we're always striving towards 50% common and 50% preferred. We think that's the right mix. We're underweight preferreds at the moment. I don't know if we'll ever get up to 50-50 because, I don't know, we're just a little bit conservative at times, but we are a bit underweight right now, which is why the offering is open under the preferred securities.
Okay, great. Great. Let's just pivot again. Can you talk a bit about the role that Regimen plays in managing the target businesses, and how are you planning on scaling? Because you own six businesses now, but what happens when you do own 12 or 16 businesses? How do you anticipate that scaling?
Yeah, we talk about this a lot internally. I guess in terms of our involvement, we don't run the businesses. We have CEOs in all of our businesses. We have finance people in all the businesses. We try to upgrade when appropriate those positions and bring in professional managers where maybe it was an owner operator before, and that we've seen a lot of good results from that. So we get very active on the recruiting of senior employees at each one of the business. We get involved with the helping companies plot strategic direction. We get involved with a lot of the financing decisions. We get involved with any of the investment decisions, like Plastifab is building a mezzanine floor in their factory, and we put a lot of financial rigor and experience to how to do that and whether that makes sense, because that's, to us, another investment decision. There's a few other areas that we get involved with. So manager compensation, obviously we sit on the board of directors, we control the board of directors in all of the businesses. So we get involved with all those, like during COVID, for example. I mean, we were very active with all of our businesses. We were surveying all the various programs that the governments were offering, and we were distributing that information through to the companies so that they could take advantage of it. The other areas that we're starting to get more active on is technology and digital transformation. So we've got a part-time consultant that's working for us that's helping implement various technology initiatives. And what we find is that with owner-operated businesses, with SME space, typically most of the owners, this isn't true for everybody, but the average owner doesn't really know a lot about technology. And so that tends to be an area that has a lot of low-hanging fruit. And so we now have somebody that's dedicated to us that we can loan out to the various businesses to help implement things like ERP implementations. An example is our crane business. We've needed to upgrade our services there for quite some time, and there's never any time for management to focus on it. There's always other more pressing things to do, but for long-term value, this is an important initiative. And so with our consultant, for example, we were able to get that put into place in 3 or 4 months. We've got a CRM in there. Now we're working on some other ones. So we're doing some things like that, Alon. And then on the scaling question, we have a position that's open right now. We're going to be filling it over the next little bit, where we have a director of operations or a VP of operations. And that's somebody that just focuses exclusively on working with our companies to help them grow. So they're out of the deal space, and we're a service provider to our companies. That's how we view ourselves. And so having people that can help grow those businesses and take their real world experience and basically be a sounding board is how we do it. So as we grow the portfolio, that part of the business will expand.
Great. Well, thank you. Moving on. It sounds like the crane business has had a reduction in revenue and needed to pivot due to the Alberta downturn in the oil industry. If the revenue has decreased, what has been the percent reduction per year? Now, I recall from the slides that the crane business was a very small percentage of the overall portfolio.
That's a good question. I honestly do not have that number off the top of my head. I don't know, because what happened was it was like this, then it went way up, then it went down, right? And now it's been going back up since then. So I couldn't even compare it to where it was from when we started or from 2016, but 2015 was an incredible year. We had a massive backlog. It's down pretty substantially from that, for sure. But I mean, that's the highest year that the company ever had. And, we're going off some of the lowest years.
Okay, Great. That's a perfectly fine answer. And Dan, if you want more detail on that, we'll circle back with you and get in touch with Cooper outside of this call.
Yeah, we're happy to do
Cooper,
that.
what's keeping you up at night these days?
Working too hard is part of it, but really just, I think the biggest challenge in this business is finding great companies and investing at a reasonable price. And I'd say that's the main thing that keeps us up at night. From a capital perspective, we've had a really great support from our investor base and from Raintree. And every time we've gone, like, we tend to be open and closed from a capital point of view. So we hadn't been raising money since 2018. We raised quite a bit of money in Q4 last year. We were almost overwhelmed with support, and so we're generally not concerned about capital. I'd say the other thing that we don't have anything like this right now, but it's people at our companies is always a challenge in this business, and that's probably the other thing that there's nothing particular that's keeping us up at night right now, but if I were to look back over the last couple of years, it would be people issues.
Sure. I think that's probably the case in any business. So folks on the call, a couple of things. One, if you do have any questions or comments, now is the time to pop them into the Q&A box at the bottom of your screen. Please just click on that Q&A box, type in your questions or comments. I noticed that a couple of attendees showed up quite late. This call is being recorded and it will be made available through Raintree. Please just contact your dealing representative to get access. It'll also, I believe, be posted on the Raintree website. Cooper, this is $1 million of capital that you're accepting at this point in time. We expect it's going to go fairly quickly. So if you are interested in investing in the Regimen Prep, please contact your dealing representative. And I imagine that in the next couple of weeks, this $1 million will be gone. With that, I want to thank you very much for attending the call. Cooper, thanks for being here and presenting. It's always a pleasure. And have a fantastic afternoon.
Appreciate it, Lon. And thanks, everybody.
Take care. Bye-bye.